We don't want to be over conservative to that extent. While depending upon the macro environment, you will do duration management, but the fund will largely be focusing on accrual positioning by participating in corporate bonds with a minimum floor of AA. What has further weakened the argument out here is the withdrawal of the indexation benefits when we are talking about, and the vice versa is also true. When equity doesn't, debt has done or fairly better. On the return side, while it may not truly give you returns as much as what an equity oriented scheme will give you in a good year, but in a bad year it will also not correct in a fashion that what equity funds may correct to.
Guest is here and इनका एक ऑब्जर्वेशन था कि हमारे 18 साल हो गए एज एन ऑर्गेनाइजेशन, and he was saying that he also spent time 18 years in the SBI Mutual Funds. I think this is a category we thought, like the couple of funds came, but we thought let introduce these. It should not happen that we hybrid remains are sort of closer to our heart as a strategy. We thought we should not miss this strategy, at least understanding perspective. Whether it fits in client's portfolio or not portfolio, maybe once we'll introduce, after that we will discuss that. So I think these people have, is already started. Already they have collected some 500 odd crores also. We thought introduce this as a strategy, understand this how it works, and you will find many AMCs will come, will probably will bring these schemes in their from their side. This will also give an opportunity to maybe understand how the market looks like on that side. So Tanmay, over to you.
Thank you so much. So like while we take you through the presentation on SBI Balanced Hybrid Fund, I wanted to touch upon 4 or 5 aspects through the presentation, and these I believe should naturally be the questions that you would have. One is, why hybrid at the end of the day? Second is, what kind of investor does this particular category or this fund truly addresses? Third is, what is the kind of strategy that we would be having within the balanced hybrid fund, and how does this fund compare with, let's say, other hybrid funds that we have in our portfolio of offering? And finally, is there a tax implication that we need to understand and explain to our investors? Let me take you through the presentation that we have here. So, whenever we think about equity journey, and if you would have observed over the years, it does come with its fair share of disappointments. Whether it is the financial crisis that we saw, whether it was the NPA issue, or very recently the COVID issue, as well as the trade war issues. And there is always going to be a set of investors out there who may not be truly happy with the inherent volatility equity market brings in. It is also very important to understand what point the investor has entered into the market. Let's say he is entered into the peak, he is always going to be an investor who has a grudge, and he will always complain that मेरा तो पैसा बनता नहीं equity market में. How do you try to handicap the expectation of such an investor? As an investor, we always think that money will be made in a very linear fashion. That 15% बन जाएगा क्या हर साल is the natural question that a lot of investors happen, which actually is the chart on the left hand side of the display. But it is never like that, right? It is always going to happen that you do see the ups and downs within the equity market. Now, with that in mind, so then is the question that should you move your investors hence to debt market? But the thing to observe here is that across markets, even on the debt side, interest rates have been only falling, which means even again the return expectation for an investor evaluating a debt oriented scheme are only going to be lower. What has further weakened the argument out here is the withdrawal of the indexation benefits when we are talking about debt oriented funds. Now that brings actually to the concept of a hybrid fund. The correlation of equity and debt, if we have seen and if we have plotted over the years, out here we have a 20-year history. The correlation is almost to the tune of 20%. What does this mean? It generally means that when equity is doing well, debt doesn't, and the vice versa is also true. When equity doesn't, debt has done or fairly better. Which means if you have a hybrid product with a combination of an equity and a debt component, then the investor is going to probably have stable risk along with an exposure to equity. And this is the kind of fund that we want to bring to your understanding. But before that, to any investor, the natural question is, what kind of investor is this fund suited? And our job should be to try and ask an investor three pertinent questions. A, what is his time horizon? Is he coming here for the short term or the long term? What is his risk tolerance? The first point to it again, is he okay with inherent volatility and fine to kind of see through the 5-year or the 10-year journey, or is not able to absorb the volatility? And third, what is his need out here in terms of financial condition? Does he need money at this point in time, or he doesn't? Is there a lot of debt that he has to service, etc., etc.? That brings you two category of investors at the two extreme, one who is really aggressive and one who is conservative in nature. And here this fund which is the hybrid category actually kind of fits in, as I was mentioning, simply because you have an investor who will have stable risk expectation but an exposure to equity. You will have a lot of your investors, to what sir was also mentioning here, that we need to highlight. Who is the investor to whom you should be pitching this? It should be an investor who wants stable risk. It is an investor who is entering into the equity markets probably for the first time and wants some exposure towards equities. It could be to retired people, pensioners, trusts, foundations, etc., etc., where you can offer again some certainty of risk with some certainty on the some certainty on risk along with some certainty on the return side. As a human being, if you see, always we will have a return expectation of the blue bar, but what we actually derive is always less because of our inherent nature of greed and fear. We tend to buy at the peak and sell at the bottom. How do you avoid or handle such a handicap, which is again hybrid? What does hybrid do, right? In case of a year which is terribly bad, wherein drawdowns are materially higher, as you can see from the chart, what we have done is we have drawn three indices. One is the composite 50-50 index, the hybrid composite 50-50 index, the nifty 50 which is a pure equity index, and the crisil composite bond index which is in yellow. In a bad year, the drawdown has been the sharpest in case of equities, but it is a bit more balanced when we talk of the blue line, which is the nifty 50 hybrid composite 50-50 index. Similarly, on the return side, while it may not truly give you returns as much as what an equity oriented scheme will give you in a good year, but in a bad year it will also not correct in a fashion that what equity funds may correct to. That is again shown in the graph out here. The blue lines are the ones on the hybrid side, the orange is the equity index which is nifty 50, and the yellow ones are the crisil composite bond index. So simplistically again put, and making a repetitive point out here, while returns are going to be a bit lower, the risk is far more calculative and calibrated in this particular case. And okay, now we keep harping on the point that returns are lower, but how much lower are the returns? What we have done is over the last 24 years, we have plotted a chart highlighting the return of the same three indexes which we just spoke of. The bond index has given a return of around 7% CAGR. The composite index, which is the hybrid category, is given 12% returns, and the equity category has given a return of around 15%. So for far more balanced risk, you are still getting a 12% CAGR return over a very, very long period of time out here. Hence, this is the fund that kind of will take care of equity market uncertainty and also be sensitive to what debt market category offers. which brings us to this particular slide, again highlighting the same point. You would always say that you are highlighting returns over a longer period of time, but what happens in any individual here? So what we have done is from 2015 to 2026, we have plotted the CAGR, we have plotted the individual return in each year across again the same three categories. And if you would again observe here, in every year which is a good year from an equity standpoint, where the returns are strongly positive, the hybrid composite index also has given very good returns, though lower than that of the Nifty 50. But what is equally more important to highlight is that in a bad year, which is the red portions within Nifty 50, the correction in the hybrid index has also been far lower than what the equity index has to offer. So it's not just a long term story that one is pitching in almost every individual year. Simply because you have a balanced portfolio between equity and hybrid, you are able to take care of the return objective of your investor, at the same time the risk category that the investor is asking for. So that's precisely what hybrid as a category is. But what truly happens is when we go out in the market and speak to our investors, they always get confused as to इतने सारे आपके hybrid product हैं, हमें किस product पे focus करना चाहिए. So while we are here to talk about balanced hybrid, I'll still take some time trying to highlight this slide, which is actually one of the most important slide in the presentation. On the x-axis you have the volatility appetite, which is the risk appetite, and on the y-axis you have the expected return potential, and from left to right you have all of our fund offerings, from the most conservative product to the most aggressive product. Let me take them one by one and finally also then come to the balanced hybrid. On the most conservative side of it, we have the conservative hybrid fund, wherein, as by now you would have realized, a hybrid fund will have exposure to both debt and equity. In case of conservative hybrid fund, you can take your equity exposure only to the maximum of 25%, which means 75% still needs to be debt, hence it is conservative. Historically, this fund has actually offered 7% CAGR returns. Next comes equity savings fund, wherein equity component can go up to 40%. What traditionally happens in such a fund category is we use arbitrage as a strategy, wherein we try to take the exposure to 65%, which is equity plus arbitrage is roughly 65%. Why that is the case? Because it then entails equity taxation, which is 12.5% on the long term basis, but it is still a fund with less exposure towards equities. I'll come to balanced hybrid, but before that, we have the multi-asset allocation fund, wherein we have three asset classes. One is commodities, which is gold or silver. Then we have equity and debt. A minimum of 10% needs to be invested into all these three categories, but it is aggressive. So you can take the equity exposure to 80%, which again allows it to have equity taxation benefit per se. This is a category which actually has given double-digit returns. The next is aggressive hybrid fund, which by default is aggressive and hence minimum 65% is invested in equities, and we can go up to 80% into equities. This again will have equity taxation by default because 65% is equities. It plays in two asset classes only. And finally, we have the balanced advantage fund, which is actually based on a predictive model which tells us how much of debt and how much of equity should be kept. And this is the most aggressive fund in our basket, where equity can actually go to even 100%. Again, here you will have the taxation which is on the equity oriented side. That brings me to the product for discussion, which is balanced hybrid. Now, if you would have seen, on the left hand side you have equity exposure on the lower side, on the right we have equity exposure on the higher side. This is a fund where you will have minimum of 40% invested into both categories, which is equity and debt, and one can go maximum to 60% into the category depending upon how our collective intelligence within the fund house is on the end market. If we think markets are going to be choppy, then we might have a slightly higher exposure towards debt. If we think that there is a lot of money to be made on the equity markets, then we can take the equity exposure even to the tune of 60%. One, it eliminates the predictive model concern if anybody has as to what they will give as an answer. It is fixated in some way. Second, the risk is quite controlled or calibrated here, because minimum 40% by default is going into the debt market, and this is a fantastic product for any investor that is, as I was mentioning, wanting to enter into the markets, maybe is like a first time investor or is a retired person who still wants to participate in equity, because India is a market which is one of the fastest growing market globally, and to that extent equity journey में participate करना जरूरी भी है at the end of the day. So this fund kind of truly allows you to have that kind of equity exposure to the tune of 60%. From a risk as well as return perspective, it sits exactly in the center of the two. Like I was mentioning, the products on the left have been offering or giving returns to the tune of 7-8% CAGR. The products on the right have been offering returns to the tune of 12 to 15% CAGR. Logically, without of course making any commitments, this fund should have the balanced risk with a return objective of somewhere in between the two that I just kind of mentioned. We can come back to this slide as and when people have questions, but just to kind of proceed, this is majority of what I kind of explained, where equity exposure is 40 to 60 and debt is similar. There is no arbitrage, there is no covered call, there is no other confusing strategy in this fund for an investor. It is an extremely simple product to understand and explain to our investors. So, okay, the next question would be, within equity, what are you going to do? And within debt, what will be your strategy? I will be managing the equity part. So, on the equity side, we are going to have a market cap sector agnostic portfolio, where the idea is to own 30 to 40 stocks. These will be the high conviction bets of SBI Mutual Fund across market cap categories that we do have. And I will further elaborate on this one. The way or we are thinking about it is to have within the equity portion 70 to 80% in the high conviction portfolio, which is what we will call as core, and we will have another 20% which will be like the satellite, where you want to participate in really long term structural small cap ideas, or let's say there is an IPO happening tomorrow, or there is a tactical trade in a certain sector or a certain stock that you want to play. So you are again managing the risk component within equities by not taking unnecessary risk and taking a significantly higher exposure towards, let's say, small caps. So it will have an orientation more towards large and mid caps, but there will still be a flavor of small caps and tactical trades within the portfolio, which is within the equity section. Coming to debt, we don't want to be over conservative. To that extent, while depending upon the macro environment, you will do duration management, but the fund will largely be focusing on accrual positioning by participating in corporate bonds with a minimum floor of AA. So anything above AA is what we would look to participate and earn returns. At the end of the day, there is also an idea where, depending upon of course the same investor category that we are focusing this fund for, they might be in need of money, and to that extent there will be a philosophy of distributing dividends also. It may not happen immediately with the launch of the fund, but over a period of time, depending upon what we think as internal frequency, we will have dividend distribution also as part of the strategy, and for which you would require the debt portion of the fund always to be at 40%, which is the philosophy of the fund. Yeah, this is a very important slide. One of the questions which I was mentioning that you should be asking us is on the tax side, what is the advantage or disadvantage? So when you think of debt funds, you have now no advantage on tax. You have the marginal tax rate of the investor, whether it is short term or long term. When you think about equity, on the long term side, it is 12.5%. On the short term side, the equity taxation is 20%. For long term, you need to hold or have a holding period of at least 12 months. When we are talking about this scheme, we need to pitch to an investor with at least a 2-year time horizon. The reason to mention that is, with a holding period of more than 24 months, it will entail equity taxation of 12.5%, and hence it fits in beautifully with his return objective. On the short term side, if they are going to withdraw before the period mentioned, then it will entail short term, which is the marginal tax rate out here. So the philosophy should be, again to repeat and summarize in some sense, to pitch to an investor who wants stable risk and exposure to equities and is willing to come in the category with a minimum time horizon of 2 to 3 years. This is about us. I have been associated with SBI Mutual Fund for 18 years. I have 21 years of experience in general. 18 years is the relevant experience which I always put it out. At SBI Mutual Fund, I am also the fund manager for 3 other schemes, which is the SBI Healthcare Opportunities Fund, which I am managing since 2011. SBI Automotive Opportunities Fund, which was one very interesting theme, unique theme that we launched in 2024. There is still no dedicated automotive opportunities scheme in the market. All competition and logistics as a theme. And from last year, I am also the fund manager for our SBI MNC fund, which erstwhile was called the Global Fund. The debt part will be managed by my colleague and CIO for the debt side, Rajiv Radhakrishnan. Maybe some of you, I'm sure, may be aware about Rajiv, who is a veteran in the industry. This is the final slide, just some relevant details for the fund, with which I kind of close the presentation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.